We are living through truly historical times. The stock market has never been this volatile. The economy is in a similar state to what it was during the Great Depression, and the Federal Reserve is printing historical amounts of dollars and injecting it into the US economy. Meanwhile, gold is on one of its strongest runs in history. This last bull run has been more powerful and more rapid to what we were seeing during 2010 and 2011 when gold was in a so-called bubble. Gold started its new bull market right here in 2019 when it broke this important resistance level right here. We made a video talking about gold entering a new phase of its bull market. Before then, it was just higher lows. And when it broke that high, it made a higher high. We were extremely bullish back then. We are still extremely bullish on gold right now because the forces behind the rise in gold are very strong and inevitable. So if you are interested in knowing why we believe that gold is heading to a minimum target of $8,000 this decade, sit back and enjoy this video. If you appreciate content on gold and you want to see more videos around this subject, make sure to let us know by clicking the like button. It really makes all the effort that goes into these videos worthwhile. So we're going to break it down into 3 separate points, starting with what is pushing gold now and what will continue pushing gold in the next few months. And we'll finish off by talking about what will propel gold higher later in the decade. So point number 1, uncertainty around the economic downturn. As we quickly covered in the beginning of the video, we have record high unemployment similar to what we had during the Great Depression. We've had a massive shrink in the GDP of the US economy. You can see what this looks like on a chart for the last 70 years. And there is increasing fear around a double dip recession. You can see this is a chart of the percentage change in consumer spending. This tells you how much people are actually spending. So basically how much they are contributing to the economy. That's essential for an economy. The higher the consumer spending is, the more money is actually going around and contributing to an increase in GDP. You can see the consumer spending has recently stalled. The stock market is currently at all-time highs, but consumer spending is starting to turn down. If you read CNBC or any financial related news channels, you'll know there's increasing fear of a double dip recession. So why is this good for gold? So this is a 100-year chart of gold, and you can see we've had 2 main bull markets so far in gold. The first one was in 1970. It started right here, 1970, and ended in 1980. You can see how the stock market performed throughout that period, 1970 to 1980. It was flat. It was a period of economic stagnation and high inflation. So that tells us that gold does well in an environment with uncertain economic conditions. If we look at the second gold bull market, it was from 2001 all the way to 2011. This was a huge bull run for gold. And if we look at the stock market throughout that time, 2001 to 2011, this was during the Great Recession, the financial crisis. So another period of big economic uncertainty. So this reaffirms that gold does well during uncertain times. And there is absolutely no doubt that we are in uncertain times. Now, point number 2 is the amount of liquidity in the system. So we're going to start off by showing you a chart of M1. It's a generally well accepted calculation of the actual money in the system. This is a chart going back to 1975, and you can see the trend has been up for years. But something happened in 2008, 2009. We had the beginning of quantitative easing, and that uptrend actually steepened. And of course, we have quantitative easing unlimited, recently, and this massively increases the amount of liquidity in the system. So before talking about gold, we're going to put this in relation to the actual economy, the GDP. So we're going to divide M1, the money supply, by the GDP. And you can see this chart goes back again to 1975, and all the way up until 2008, we had a money supply that was in correlation or even inferior to the rise in GDP, which is a healthy thing to have. This is what healthy economics should look like. If we go back to what a great economist, Milton Friedman, once said, one of his big rules is that when there is an abundance of money and not enough goods, prices will rise. And so that is commonly known as inflation. And that's why the price of everything has gone up in the past 100 years. That's why the cost of a new home was only $3,800 in 1930, and it's $300,000 now. Same thing for wages, same thing for cars, gas, bread, meat. That is called inflation, and it applies to everything, including gold. So if we come back to this chart of the money supply and we add gold to it to compare the money supply versus gold, unfortunately this chart does not go back before the gold bull market, but you can see the trend. The trend is a correlation of gold to the money supply, and gold tends to catch up to the money supply during its bull markets. It underperforms during the bear markets and then catches up again during the bull market. And this is something that we will see again now. Gold is already well on its way to catch up to the liquidity. And we believe that this is only the beginning of the printing of money for the Federal Reserve. We think the balance sheet is going to expand much more than it already has. So $8,000 is a very pessimistic target for gold. If you're so far enjoying this video, if you enjoy the charts, make sure to like the video. It really helps us out massively. It does take some time to prepare these kind of more fundamental videos. So the third and last point that we want to make on gold is uncertainty surrounding inflation. As we mentioned earlier, a rise in liquidity is responsible for a rise in prices for everything. That is inevitable, and anyone that tells you it's not going to happen has not understood anything about basic economics. So far, the liquidity in the past 10 years has remained in the stock market, it has remained in the bond market, the housing market, because of how the financial system is currently structured. This is why the stock market has strongly outperformed in the past few years. This will eventually translate into rising prices for gold, rising prices for commodities, and rising prices for consumers. We are already seeing that phenomenon in gold. So inflation is something that we will see later in the decade, probably 2023, 2024. And considering the massive amounts of money printed and injected into the system, we are likely to have large amounts of inflation. Most likely levels similar to what we had during the 1970s, averaging around 10 to 15% of inflation at its peak. In an environment like this, with prices constantly rising 10 to 15%, that causes extreme uncertainty. And what that does is massively increase the actual demand for assets that have intrinsic value. So assets like gold, assets like real estate will tend to outperform in this type of environment. And we can look at what happened during the 1970s for gold prices. As we mentioned earlier, prices were in a huge bull market during that time. So if you understand what we are trying to explain, not only will gold be pushed by liquidity being injected into it, but also by the uncertainty around the inflationary environment. Gold is one of those assets that historically keeps its value. It has kept its value for thousands of years. Spartans were already using gold as a store of value. Again, anyone that tells you that gold does not have an intrinsic value has not accurately studied human history. So that's about all we wanted to cover in this video. We hope you guys enjoyed this video. It did take some time to prepare. So if you enjoyed, make sure to drop us a like and subscribe to the channel if you want more content like this. In the meantime, good luck on your trading and see you next time.